Today is Tuesday, May 30th, and this is ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. Today's guests are Steve Freed, Vice President of Grain Research at ADMIS, and Alan Bush, the Senior Financial Economist. Steve, soybean prices made new lows for the move last week. Would you please comment on that? What should the farmer do? And conversely, what should the buyer or end user do right now?
Well, the market gave up some of its premium because of three things. Number one, it looks like China was slowing down some of their purchases, and there was rumors that they may even cancel some U.S. sales that are open on the books. China's crush margins have collapsed. Their meal domestic prices are the lowest in 4 years, and so that's all kind of a rippling effect back into our marketplace. We're also looking at the weather, and farmers here in the United States may plant more bean acres, and we already have the carryout going up. And then number three, I think we just had some spec longs in the beans because of the demand, and I think they're liquidating because of poor technical picture. The farmer, we've been saying all along from the highs that they should sell the beans and maybe replace them with calls. I mean, soybean prices could go down another $1 if we don't have any weather problems this summer. So they still should be looking at the possibility of selling the cash beans and replacing them with a call. For an end user, this is one of the market that when you make new lows, you kind of wait a little bit. If this is profitable, whether it's meal, oil, or beans, lock in some of the things that you need, but the market may go lower.
Corn and wheat futures remain in the current trading ranges. Will this continue? Under what scenario will prices break out of this range?
Well, for especially corn, we really don't know about the final crop until mid-July. So we expect that for corn, we're going to stay in this trading range. And we had put a premium last week in case we came in today and the weather was wet and cool. It looks like now the weather forecast is going to do some changing. So we're going to get away from this cool weather and draw a line across, let's say, the southern third of the United States. It's going to get warm and dry south of that line, but north of that line is going to be good. So the concern right now is even though corn prices are below break even for farmers, it could go lower. And from an end user standpoint, you kind of want to wait and see how low is low. And the way we break out of this range is 100% weather. And talking to our weather guy this morning, he sees no problems north of that line this summer across the Midwest. So we should have some good crops.
And the USDA today will issue the first U.S. 2017 corn crop rating. What will they say, and how important are these early numbers? Is there a high correlation at all with final yield this early?
Last year this week, the crop was rated 72% good to excellent. It's one of the highest ratings that we've seen. We expect something around 67%. You could see Iowa and Minnesota above 80%, and you can see Illinois and Indiana below 60%. There's zero correlation between this rating and the final yields. It's going to be not until mid-July until we get a strong correlation between what they come out with ratings and then the final yield. So everybody will trade it, but I think more importantly they're going to trade the weather. With right now, the next 2 weeks looks pretty good.
Yeah, finally, Steve, U.S. crops are good, in really good shape in the western portion of the Midwest. Continued wetness seems to be stressing the east. Does this matter right now, or?
Well, it matters to the farmers in the east because we get emails from them saying, I'm flooded out, my corn looks bad, I can't get my beans planted. When is the market going to realize that? So I think the main thing is they have to realize that it's an isolated area. Number two, we have record global stocks. We don't have any other weather problems around the world, and we have plenty of time to improve the weather, and the conditions of their neighbors in the West are probably the best that they've started out with in a long time.
Let's switch over to financials. And Alan, first quarter GDP was stronger than expected last Friday, coming in at 1.2%, when economists had expected the number at 0.9%. How does this affect the outlook for the Federal Reserve policy?
Well, basically it suggests that the Fed will probably be raising at their meeting next month. They have a meeting on the 14th, so they'll probably raise by 25 basis points. Whether or not they raise again in December is another question. My feeling is that they will probably hold off in December, but it's very much a strong probability that they'll raise on the 14th. Currently, the probability is 89% for a Fed funds rate hike next month.
In light of the renewed political uncertainties in Washington, and there's a lot of them, and a likely Fed funds rate hike in June, what is the long-term outlook for stock index futures?
Well, traditional thinking is when the Fed raises interest rates, traders often think that's the end of the bull market. But if you recall, we did have 2 rate increases already, and another one very much on the horizon. So we feel that even though the Fed is likely to raise, that this will not get in the way of the bull market for stock index futures. In fact, we did see some new historical highs last week in the S&P and the NASDAQ. So continue to trade the indices from the long side. There's a lot left in this bull market for all of the major stock index futures.
What type of political issue would really damage the stock index futures right now?
Actually, any political issue from anywhere in the world, any type of geopolitical event would be a negative. But as we have seen since the lows were put in March of 2009, every time there was a geopolitical problem, stock indices came back and ultimately made new highs. So if there's any problems, whatever they might be, I would expect, of course, the obvious sell-off followed by a new round of highs.
So our president is basically just providing us some buying opportunities.
You could look at it that way, and it is a buying opportunity.
Alan, let's talk
Very
gold.
true.
Let's talk gold. The June gold futures broke out to the upside from a symmetrical triangle formation on Friday. What is the rule of thumb for breakouts from a congestion pattern, and what is the outlook for the gold market now?
Well, the rule of thumb on any congestion pattern, and this was a symmetrical congestion pattern, is that normally a market will break out of a congestion pattern in the same direction that it came into it, in this case to the upside. So with Friday's breakout, there are projections now for the June gold to trade up as high as $12.98, and that would be a new high for the year. So any weakness should be used as a buying opportunity, and I'm thinking minimal weakness, $5 to $8 breaks, and that would come in around the $12.58 area basis, the June contract. So that kind of a break should be used as a buying opportunity. Once again, there's a lot left to the upside in the precious metals, especially the gold, and I think, of course, we'll see some new highs for the year in the gold futures.
Thank you both. Remember, the views and opinions expressed today on this video are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland Company. If you'd like more information about our brokerage services, would like to speak to one of our experts about managing your risks, or would like to open a trading account, please visit www.admis.com.